This channel is for educational purposes only. Make sure you do your own due diligence before making any investments. And there is inherent risk in trading, so it's speculative. Just make sure you keep that in mind. Hi, this is Joe Rabil with Invest Like a Pro. I wanted to follow up on the ADX video and do a video on MACD. So about a month ago, I did a lot of the major or most important components and aspects to ADX. A pretty long video that covers a lot of different things, but I got a really good response on it. So I wanted to do the same thing for MACD. And so, in this video, I'm going to talk about some of the most important aspects of MACD and how it can be used in multiple time frames. I wrote a book called Invest Like a Pro. Several of these patterns are in the book. I am going to, cover a lot of those today. One of the things that I noticed about some of the videos that I did was that I did a lot of MACD videos early on the channel when I didn't have a lot of subscribers, and I still don't actually. It's still early in the progress of this channel, but back then, I really just had a few, and I wanted to make sure a lot of the people that have subscribed over the last 6 months see some of my earlier videos on MACD, because I do think they're pretty important, and they cover some pretty key aspects to this great indicator. So I cover the MACD pinch play. I cover it in relationship to a change in trend for price. So I like the way these videos are done, because the way it's really a refresher course on the 1, 2, 3 change in trend as well, and how MACD pinch play can be used in conjunction with the change in trend. The other thing I wanted to make mention is that I do several videos here that talk about intraday timeframes. I've got some 10-minute and 2-minute that go back to when the market crashed back in 2020, early 2020, and some of the short plays that we did. And those were really micro time frames. You can apply these same indicators or these same videos that I've done. You can apply them to a monthly and a weekly. It doesn't have to be done on a micro time frame, or it doesn't have to be done on a long-term time frame. It's totally independent of time frames. So just make sure if I'm showing you something on an intraday time frame, it can be applied to the longer term as well. And then I cover MACD divergence. I think there's some key criteria that you need to know to kind of keep yourself out of danger on MACD divergence. And then zero line reversals have to be covered. One of my favorite patterns, and it's a great pattern to use when you're around that zero line, obviously, but also in conjunction with the moving average. And so I finish it off with some combinations of how MACD can help with the timing when you're looking at the moving average signal. So I hope you enjoy this. Please feel free to make any comments or questions. I got a lot of feedback the last time, and happy to get that. Also, if you're not a subscriber, I suggest you do that. We've got a lot of changes coming to the channel, as well as to the investlikeapro.us website. I want to spend some time talking a little bit more about the 2 time frame pinch play. I outline this in my book. I have an entire trading plan in the book. It goes into a lot of detail as to how many to do at a time and how much to risk per trade, and how many to do per sector and all. But I wanted to spend more time on the actual signal and setup. And the main reason why I like this as a trading plan is because if someone is new to trying to trade in multiple time frames, this gives a really good way of learning and getting more proficient at it. There's a few things about the setup in the 2 time frame pinch plan that actually I think is pretty important. First of all, it's going to use 2 time frames. The higher time frame is your tradable time frame, and it's going to find the trend. It's going to tell you what the direction of the trend is by following the rules. And secondly, it's going to make sure that that time frame isn't too overbought, because there are a lot of times when a market might be, or a stock might be looking strong or in a good trend to the upside, but it's not really timely because it's already made a pretty big move. So by default, the rules of this approach sort of eliminate that kind of risk. So I really like that aspect to it. And then it also helps you understand how to wait for the trigger on the lower time frame. So let's get right to it right now. I'm starting here with a monthly chart of Chevron. I really want to make this point again. I use monthly, weekly, daily a lot of times. I could go show you a 60-minute. I could show you this pattern on a 10-minute and a 2-minute right now. But I'm using, I like to mix up my time frames, and I like to use the monthly, weekly, because I think, number one, the trends are very smooth. And secondly, I think it gives you a really good idea how you could put some money to work and not have to agonize over it on a day-to-day basis. You could put this trend on, you could put your stop in place, you can put your targets in place, and you really don't have to sit there and watch every tick. So getting back to Chevron, I'm just going to, I want to point out this spot. I'm going to just highlight this area right here. This is the zone that I want to focus in on. And just to make things a little clearer, I'm actually going to add in an indicator. This is my zigzag again. And what I'm trying to point out here is the trend was down through this period in 2015. You went down, 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 right? And if I were going to go and draw my trend line in place, here's the low. I'm going back to the prior high, the prior peak, and that's my anchor point. So I draw the trend line in, say this way. And I have a break of the trend line. I actually, broke it here and then tested the low and then turned up. And when you took out this peak, the trend is now up again. And then it actually made another peak here and then another low. So you're clearly in an uptrend. By the time you reach this colored area, this shaded area that I've created, and you pull back from it, clearly the monthly trend is positive. I'm going to just pull this over and let's look at the weekly chart during this time frame. Let me just spread this out a little bit, zoom in a little bit so you can see it a little clearer. So the point I'm making is you broke the downtrend on the monthly, you've turned up, and the trend is now to the upside. And this is truly your first pullback to the 18, which is now rising, the 18 on the monthly chart. And I think this is a really good area. If I want to do this on a weekly chart, this area is a great spot. Pullbacks to the 18 week, pullbacks to the daily 18 day. But I like to look for new trends that are pulling back to this 18 MA area. And then I'm going to go and look at I'm going to describe the pinch, which is the MACD line is the red line. The blue line is the signal line, which is a moving average of the red line. And when the blue line turns up, I know the trend is to the upside. What the red line is doing is it's a little more sensitive because it's following the movement of the price action a little bit more closely based on the closes. And when the red line starts to hesitate or pull in a little bit, counter to the blue line, I know that I'm getting a pullback in an uptrend. So if the red line pulls back or pauses while the blue line is rising, I know that I've got a pullback into an uptrend. So it gives me a little bit of an advantage knowing the blue line is giving me a little bit of a confirmation as to what I'm seeing on the higher time frame trend, because I know I've broken the trend line. I've got my 1, 2, 3 change in trend to the upside, and now I'm getting my pullback. The pullback is being confirmed by this slight little pinch here. So I've got this area blocked off. And I just want to point, so I'm going to take this box off in a second. I'm going to take off the zigzag as well. But I do want to point out, if you notice on the higher time frame, this is just this whole move from here down to here is just a simple pullback, meaning you go from a high, there's no lower high along the way. It just goes straight down to the bottom and then starts to turn. Now, there is one little hesitation point here, but it's really not a factor in this situation because you don't have a trend to the downside. It's still trending to the upside. So I think that's a really key point I just want to make. So let's go and look at the weekly. And I'm going to zoom in a little bit. Notice what happens on this simple pullback on a monthly chart, which is just the line is just a straight line going down. Through that whole period, you made a low, and then you made a lower high, and then you make a lower low, and then you made a lower high, and then to make another lower low. This is a trend. So on a weekly chart, you're in a downtrend through this period, but on the monthly, you're still in an uptrend. This is key criteria. I think you need to understand what you're seeing if you're going to trade in two different time frames. The rules for the two time frame pinch say I'm looking for two lower highs on the higher time frame, and I want to see some type of a hesitation in the red line while this is staying above the blue line. But the key criteria is making sure I've got two lower highs. Well, I've got that in place. The second thing I'm going to do is I'm going to go down to the lower time frame, and I'm going to wait for the next time that actually happens on this time frame, which is where the red line crosses above the blue line, which is meaning MACD is crossing above its signal line, and then I get the pullback, a two lower high pullback. That's actually taking place right here. I wanted to keep this box on for just a second, and the point I wanted to make, I'm going to delete it now, is through this period, as you're pulling back, you kind of want to know what is taking place. So if that's the low point, that's the low. I'm going to go back to the prior bar. That's my anchor point for my trend line. I'm going to draw in a trend line here. And I know that I'm breaking the trend line. I've moved up and I'm pulling back to test the low. And then when I take out this high, that's my 1, 2, 3 change in trend. So I broke the trend line, that's 1. I came back and tested the low, that is 2. And when I took out this peak, that's 3. So after this rallies up and pulls back, and I get this is my two lower highs and my second pinch right here. This pinch play is now confirming that I'm starting a new uptrend because I've already done my 1, 2, 3 change in trend on this time frame. This is my first low risk pullback and entry on the lower time frame. So just by following the rules of a two time frame pinch, I am following the criteria of change in trend on the higher time frame and buy a pullback, and then lower time frame change in trend and buy a pullback. So I think what I really love about this two time frame approach and using the pinch is that it really helps you identify the key buy areas. Again, if you want to trade in multiple time frames. So this is sort of the key. I don't want to go in too much more detail. Your target areas for this type of trade, they can be at this level. If you really like what you're seeing on the bigger time frame, you could go up into the higher levels up here as your risk reward, or you could take a partial profit here and look for a bigger profit on another half up here. There's a lot of ways to manage the position. I know I say 3-to-1 in the book, but there's a lot of opportunity to change that. You could go for 2-to-1 or 3-to-1, however you'd want to do it. If you did 2-to-1 here, you would take a full profit at this prior high. And then if you notice, another pinch play develops and you would have gotten long and you would have made another 2-to-1 going up into this peak. So I don't want to get too hard and fast with the rules on the targets. All this is outlined in my book, and I give a lot of detail in there and a lot of examples. But I thought I'd just make sure that I want you to understand the importance of why I think this strategy and using this strategy as a training tool can be really helpful. Wanted to follow up on the last video, which was the two time frame pinch play, which was on a monthly and a weekly chart. And I'd like to show the exact same trade. It's not exactly the same, but it is the same method. And it is a two time frame pinch play, but I'm using a 10-minute and a 2-minute chart of EMR here. So I'm going to start again looking at the little higher time frame on the left side, and I'm going to actually draw in a trend line here that shows the downtrend line being broken for the first time in 3 or 4 days. And again, what I'm trying to do, I'm trying to look for the earliest point where on the higher time frame, it looks like the trend is shifting. And in this case, instead of waiting for a confirmed change in trend, I get the break of the downtrend line.
and it actually fails at the 18. But what it does is it forms a pinch play. I consider this a pinch, even though the red line, the MACD line, is not coming in closer. I'm getting a pullback in price, and this line is sort of hesitating, and this line is moving up more aggressively. So I would consider this still a pinch play from that standpoint, especially because I've broken the downtrend line on the higher time frame. So once I have that, I'm going to go to the lower time frame, and let me just zero in on that so we can see it. And when I look at this chart, the same thing holds true on this time frame. I am looking for the same situation where MACD crosses above the blue line, the signal line, and then pulls back and gets a 2-bar pullback. But I would prefer on one of the two time frames, I would like to see the pinch actually accentuated. And if you notice on this pullback, you did make a lower high here and a lower high here, but there really wasn't much of a pinch. So if I don't have a pinch on this time frame, what I would consider to be a more accentuated pinch where it's very visible in the MACD, and I don't have one on this time frame, it's kind of an aggressive trade. So I would prefer to either have it on this time frame where I get a deep pullback and I know that I've got a deep pullback based on the MACD, or I get it on the lower time frame. And in this case, it would have taken place here. So I would have broken the downtrend line, I would have moved up, pulled back, broken out above this peak, and that would have changed the trend to the upside. That would have been my 1, 2, 3 change in trend back to the upside. And now I'm getting my first pullback on the lower time frame to the 18. And notice this, the more accentuated pinch play that is developing on the MACD. Clearly, the blue line or the trend line or the signal line is rising, and the red line or the MACD line is pulling back to it. It's very crystal clear. And I've got 1 lower high, 2 lower highs, 3 lower highs, 4 lower highs. And as soon as this bottom one is taken out, this last bar is taken out at 73, I want to get long. And I'm going to put a stop in at 72.94. So I'm literally doing this off of a 2-minute chart, and I'm risking about 6 or 7 cents. If it turns on a dime and comes back down, I'm stopped out and I lose 6 cents. If it works, because I'm playing a turnaround play, I'm gonna definitely go for at least 2 to 1. If I had more time in the day, I mean, this is occurring at 3:20. It's kind of late in the day for me. I definitely don't know if I want to do this late in the day, but I would definitely do the trade and try and get, a 2 to 1 move. That would have happened. You would have probably been in and out if you went for 2 to 1. So let's say you risk, $500 and literally in about 10 minutes, you've made 1,000. So that's kind of how this would play out. It would be that type of a trade. Depending on how you want to risk these type of patterns, it depends on the size of the account. I would be a little careful about being too aggressive in terms of how much you risk in these trades, because it is kind of a make it or break it type of a pattern. And it's the type of thing that, your odds are probably 50-50. I'm not trying to say that you're going to be right 70 or 80% of the time doing this. But if you do a 2 to 1, so if you risk 500, or let's say you risk 200 to make 400, and you're right half the time, you're going to make a lot of money. And I think you have to think about trading that way. You can't assume that you're going to be right every time. It just doesn't work like that, especially on an intraday basis. I think if you do it on a weekly chart, a daily chart, weekly chart, monthly chart, your numbers are going to go up. You're going to have a higher win rate. But on intradays, with the tweets out there and everything, you could get in right before a tweet comes out, and 6 cents is nothing in a stock like this. So you got to be really careful if you're going to trade intraday. But I thought this was really worthwhile to show that this is essentially the exact same pattern where you break the downtrend line, you rally up, you pull back on the higher time frame with improving momentum characteristics, and what I would consider to be, and what I describe in my book, Invest Like a Pro. This is definitely one of the signals that is, it's essentially a divergence signal in a way, because price is making a double bottom and the MACD is just not pulling back. So I kind of like that at the end of a move after it's been going down for 4 days. And then you go to the lower time frame and you're looking for the 1, 2, 3 change in trend. And the first time you get your pinch play chart of UNH up here, I've got the weekly chart on the left and the daily chart on the right. I'm going to show using these different time frames. I'm going to show how MACD momentum divergence strategy can be used and implemented. It's easy to lose money playing divergences if you don't know what you're doing. So you have to be really careful about how you play these. And I think it's very important that you recognize that there has to be other elements in place. If you just play divergences on their own, especially counter trend, you're going to have a very high loss rate, not a high win rate, a high loss rate. So you need to be really careful about what you're looking for. So let's get right into it. On the left side, again, I've got the weekly chart, and I've actually circled this spot on the chart because this is really the trade location that I think is kind of important when I look at this. You came down and tested this big spike low, and there's another factor here that I think is really important on the high time frame. I'm actually going to use 3 time frames for this particular setup. The weekly is giving me the trade location and the fact that I have an upward bias in place. The second is the daily, and that's going to give me the actual core momentum divergence signal. And then I'm going to go down to an hourly chart and I'm going to refine it, and I'm going to look for another divergence and a few other signals in place to really give me a trigger that'll be much earlier than if I just waited to get a trigger off of a daily. So this will make sense after I get through this. I'll go through it quickly, but let's just start with the weekly. So I know that this is the test area, but prior to the test, the stock had made a low here, and then it rallied up and failed, and then it made a lower low. So I can draw a trend line in place off of a lower high and a lower low. And I can see that on this rally off the spike, you broke the downtrend line. And in my book, Invest Like a Pro, I talk about a 1, 2, 3 change in trend. The first aspect of changing the trend is number 1 here is breaking the downtrend line. So I have a downtrend in place and I've broken the downtrend. Number 2 is testing the low. Now, you don't have to come all the way down to the low like this. You could test it from here. I don't know that this is maybe enough of a test, but you want to see at least, it's better to see a 50% retracement, but either way, I'm watching this and you can see the price action is pretty negative, especially here. And then you finally get down and actually make a full-fledged test of this bottom. So I would call that 2. Now, 3 is breaking out above this peak. That would be the change in trend on a weekly chart. I don't want to wait for a move all the way up to 270 after it made a low at 215-ish, all the way up to 270 to get a buy signal. So I'm going to go down. This is why I use multiple time frames. I know I've got 2 of the 3 conditions in place that tell me that a change in trend could be developing. So I want to go down to the daily chart to find to refine my entry a little bit more, see if I can get either a divergence or a change in trend or some sign that the reversal is going to kick in well above this breakout area up at 270. So I'm actually going to switch this chart to a daily so we can see this on this side. And then I'm going to switch this to an hourly chart, and I've got to go back in time to get to this spot. Now, again, if we look at it and we see the circle, so I know that on the way down on the weekly, it was dropping. And if I look at this drop on a daily, let's just look at the MACD. The MACD crossed down through the 0 line. You got both MACD and its signal line crossing back below the 0 level and just dropping very hard. This made a new low here with price. There's no momentum divergence whatsoever because price and the MACD are in agreement. Then we made a rally up. And during this rally, the MACD actually crossed above its signal line, which is okay. But it's usually an early warning sign that, we could be losing momentum to the downside. Alexander Elder actually calls that breaking the back of the bear. So, when we do that, we've taken a lot of the momentum out of this move. So once we drop down this second time, now we're at the new low. But in the difference here is price is going to a new low, but MACD does not. So the low point in MACD is here, and that's price right here. And then price goes to a new low compared to this low. But the momentum, or the MACD, the red line, makes a higher low. So if you were to compare those two, this is actually a higher bottom on the momentum indicator. And momentum is one of the few indicators out there that has a leading component to it. It can give you an early warning sign. So it can be very attractive from that standpoint. So I know I'm in this area here. And once price goes to a new low on this chart, as soon as it takes out this bottom, I know I have potential divergence in place. It doesn't mean it's an automatic buy when price hits a new low and the MACD has not. Because if price kept dropping here and just kept dropping and dropping, the MACD is eventually going to go to a new low. And then you're not going to have a momentum divergence in place anymore. So you have to wait for price to confirm a divergence. You can't just buy the moment price goes to a new low and the MACD hasn't. So you have to look at some kind of a trigger. The problem I have is if you wait for the red line to cross back above its signal line, you're waiting a pretty long time and the stock's going to move up 4 or 5 days. It's not as early of a signal. So I want to go down and look at an hourly chart. I want to go, and I'm going to zero in just a little bit on this chart, because the fact of the matter is, once this goes to a new low, I'm looking at the MACD. I'm looking at the hourly chart with the MACD and the moving averages. And I'm saying, okay, I want the first sign on an hourly that I've got a pretty high probability change in trend developing to the upside. Now, sometimes it'll be just a classic momentum divergence, but it can't be by itself. And here's what I mean by that. I need to have some form of a break of a downtrend in place that tells me that the momentum is switching back to the upside, or that the trend is trying to shift back to the upside. And if you notice, in fact, I'm going to zero in on this because this is very important. If you look at MACD by itself, and price, you can see that you made a new low here and MACD made a new low. And then this rallied up here and came down and made a minor new low. That actually did make a new low right here, and MACD did not. That is momentum divergence right here. Okay, that is a momentum divergence signal. The problem I have with that is that you're still below the main downtrend line. And it's a very, very aggressive type of momentum divergence. If you play this type of momentum divergence, you have to be very, very quick to get out. This is where I see a lot of people lose money. They play divergence by itself on an island with no confirmation from the higher time frame. They're just saying, you know what, I'm just going to dive in and hope for the best. And in a lot of cases, they get a little bit of a move in their favor when they really should just get out. It ends up coming down and stopping them out. So I would prefer, if I'm going to do this, and I'm looking for an earlier entry, because you got to realize the trade time frame is the daily. I'm trying to improve my timing and lower my risk using the lower time frame, the hourly. So the way I would do that is I would look for a break of the downtrend. Now I've got one. That's the first sign of a change in trend using price only. Forget the MACD right now. I'm looking at price only. I break the downtrend line and then I come down, and this actually undercuts this low. But if you notice in the rules that I say for 1, 2, 3 change in trend, you can come down and undercut the low barely and still be considered a 2. Sometimes you just undercut and rally after a break of a downtrend line. So that can definitely take place. And in this case, that's exactly what happened. The beautiful thing about this is this time you made a lower low, and this made another significantly higher low. And I know I've got momentum divergence in place, a bullish momentum divergence, but this time I have it with the price action in place. And so when this breaks come back above that trend line or above this low, I can use the 212 bottom as my stop, and I can get in at this level. And I think there's a pretty high probability based on the weekly chart and then going down to the daily divergence that I've gotten in at a very low level on a daily divergence. So again, I mean, I'm using 3 time frames here. The weekly's giving me the zone where I should be looking, the trade area. The daily is giving me the actual critical signal of a momentum divergence buy signal. And then the hourly is really just helping me with the timing. I don't want to get too crazy and trade off the hourly completely. I think you use it for your entry points. And then, you probably want to trade off the daily after you get in and maybe use these swing lows as a stop point. Because this was so volatile, you might have actually been taken out of it using an hourly. Whereas if you stuck with the daily trend, you would have really made pretty big money using that strategy. Just using the hourly as your entry or your trigger, and then maybe just sticking with the trailing stop off of a daily chart. So I thought this was pretty important to make sure you understand how to use momentum divergence. Because if you go and look at MACD or any type of indicator for divergence by itself, the odds of you making money, a counter trend using that, are probably going to be pretty low when you do it by itself. Up to the spider trade I mentioned last week, there was another few opportunities. If you were watching, looking at a 10-minute chart on the left side of the spider, on the right side is a 2-minute. There were actually 3 consecutive trades over the course of really 3 to 4 days, based off of a zero line reversal pattern on the 10-minute chart. And one of the things I wanted to point out is that it just, a lot of times, so this is the first one right here. On the 10-minute, a lot of times you're not going to get a rally all the way up to the zero line exactly. You're not going to get this red line to come right up to that level and roll over. It's just not a perfect world. You have to kind of take it and look at the pattern and look at the price action and recognize that, yeah, I would still consider this a zero line reversal, even though it didn't get right to the line. Sometimes it'll overrun and sometimes it'll come up just shy. But I think if you're doing if you're going through the process and understanding what to look for, you'll see these trades and be able to execute them. So I'm not going to actually show you this. I had a request to go through and start from the hard right edge. So I am looking at this pattern right here as if it's in real time. So we're looking at this right now. The stock has rallied up. So we had a big gap down. I mean, this is the midst of the big market drop. Big gap down in this spider. It had a little follow through. Some divergence developed here. You rallied up and then you failed. You did a zero line reversal. This was a 1, 2, 3 change in trend on a 2-minute. Even on a 10-minute, you can actually see that the 1, 2, 3 change in trend as well. Big down move. Now you're getting another rally up. And I recognize that this low versus this low, I mean, this is a pretty big momentum divergence here, looking at it from that standpoint. But when the moves are so violent to the downside, like we're seeing, I don't know that, that type of divergence is really going to play a big role. So it's not something I really pay that close attention to when it's counter trend, when it's this powerful. So anyway, we're looking at a rally here. It's moved up. The trend line is still holding right now. But if I look at what's happening on the 2-minute chart on the right, I see higher highs and higher lows are developing. I've got the same trend line in place. And now I've made a higher high right here. And the momentum is not confirming this move. So as I've said in several videos, it doesn't mean that it's an automatic short when you get momentum divergence. It's sort of just like it's giving you a little bit of an early warning sign that we're maybe starting to lose some momentum. So I'm just going to start scrolling through this one bar at a time. And you can see we got a little bit more follow through. But the MACD line has not made any more progress. And so we just keep watching. And now we get a trend line break. Let me just bring the 10-minute up to date. So we've got a 10-minute showing a break of the trend line. We've also got the 2-minute doing the same thing. I don't short or put on trades based on trend line breaks most of the time. Most of the time, they're not as timely. You can do it in certain instances, certainly in a very quiet environment where it's been going sideways for a very long period and then it breaks out from there. A lot of times the trend lines can be very, very important. But right now I would just say, I'm going to be more focused on a 1, 2, 3 type of a pattern. So what happens is this follows through to the downside, and then we get a little bit of a rally. Now, I know what's happening here. I'm at the 0 line on the 10-minute right here. We've rallied up and the red line is in the zone. So I'm in the area where I would be very concerned about a potential reversal taking place on the 10-minute chart. Now, if I go to the 2-minute, I have now broken the trend line and I've rallied up to test this area. So if I got any kind of ensuing weakness from here, I would want to short this. And that's basically what we did. When we saw any kind of weakness in this spot, I would put a short on, and I'll show what happens from here. But once this big bar showed up, in the midst of this big bar, we did we actually did puts again. But let's just say that you shorted the spider as a stock, and just did it as a regular stock trade. If I put this trade on here, and let's say I'm in at 317 or something like that, I'm going to be putting in a stop above this peak here. And I'm really going to be watching like a hawk this low right here at 316, because I know the change in trend actually, the high probability, or the probabilities that the trend is changing to the downside, will increase dramatically if I take out this low. So I'm going to be watching very closely, because this is actually somewhat of an aggressive trade if you think about it. The 10-minute has rallied up and broken the trend line. I know I'm in the area of the 10-minute, the 0 line reversal potentially, but I don't have a confirmed change in trend yet on the 2-minute. So it bounces around a little bit in here, and it finally gets through. Now at this point, if I'm looking at this and I've put a trade on at 317, let's just say that I think we actually got a little bit better entry, but let's say we're in at 317 and my stop is at 318. And I'm just using round numbers, but you have risked $1. I'm now up about $1. I'm going to go to a break even here. I could potentially trim this back a little bit. This is if I'm in the stock. In the options, we play for much bigger plays. We don't necessarily trade it this way, but for a short-term intraday type of a pattern, I'm probably going to be doing a little trimming here. Maybe take a quarter off or something like that. If I've done 500 shares, you might take 100 off or something like that, just to book a little bit of a gain and make sure that I'm not going to lose any money if it turns on a dime and turns right back up. What actually happens here is it starts to move aggressively down. Now, there's a few spots that I think you want to be on the lookout for. This is a low area that I'd be on the lookout for, and a gap fill area. So these two spots, especially if they coincide with, let's say, like 2-to-1 or 3-to-1, I'm kind of looking for, the money management area, which would be 2-to-1 would be around 315. Well, I don't need to get it down to 314.75. I don't have to be perfect. If I get it down to 315, that's good enough for me. And I'd probably be looking to take a little bit more off there. Everybody's going to have their own strategy. I'm more inclined to just kind of piece it out and sell it along the way, as opposed to take big chunks and or sell it all at one spot. But I'm going to be on the lookout for these specific area as it's moving. Let me bring the 10-minute up to date, because this rallied up and then it dropped down. So I now know I've come into this zone. I'm probably going to take a little bit more off, but it just keeps dropping. And now we fill this gap. So there was a gap fill from a few days ago. I definitely want to be looking to do a little bit more trimming if I haven't already. And we get a decent rally ensues off of this. So at this point, you have different methods for how you want to handle this. You've made some profits. Your trailing stop could either be very, very aggressive, where you'd have been stopped out on a move back up here, or you could give it more room and realize, you know what, I bought this or shorted this at 317. Even if I, put it in a stop at 316 and give it some room, I'm still locking in some money. So it really kind of depends on whether you want to stay with the trend, and whether you would like to just get in and get out. When I see the 10-minute kind of confirm and roll over and get the MACD line to cross down through, a lot of times I will just switch and say, you know what, I'm gonna, with whatever's left. Let's say I have a third of the position left. I'm gonna use the 18 on the 10-minute now and see if I can't play for a much bigger win. So I know I've booked some profits. I've made money on this trade. The worst thing I'm going to do is make a little bit of money. The question is, can I turn it into a bigger winner? And it's got to be in the right conditions. I mean, we're in very extreme volatility conditions where I think you can play for, really big wins and stuff like that. So you got to realize what you're dealing with. When the volatility is lower, I mean, you get a move that's a point and a half off of a point of risk. That's a great trade. You just want to take the whole thing. But in an environment like this, where there's a lot more volatility, I think you want to try and get bigger wins out of it. So as we continue on here, it dropped down again. It's getting a little bit, this is turning into a longer trade. I mean, if I put this trade on, just before lunch and it's 2:00, I mean, I've been in this a couple of hours now. I'm probably going to get, be looking for a spot to maybe just take out the rest. I noticed that this drop here doesn't have the same, you didn't make a new low on a momentum basis. And while I don't see that as being, I mentioned this here, it's not like I'm sitting there hyperactively looking at this, but in this instance, because you've had such a big drop and you've made a lot of money, I think this might be a good spot to actually take some profits. So somewhere in this zone where you've had a big win. So anyway, I just wanted to point out, this was just one example. There was one more trade on the 10-minute that showed up. There are three of them back to back. The entry on this one, I'm just going to show very, very quickly. As this rallied up on the 2-minute, so there were two different types of entries here. If you played it more aggressively, you could have made a more aggressive trend line move and done the 1, 2, 3 change in trend, which was also a 40 to 18 bounce right here. You could have gotten short at that point. We actually didn't play that because we thought the rally was pretty strong the way it was developed. We actually thought it was more climatic, but it really wasn't at this point. And we waited for this signal, which is a more confirming signal. You're breaking the main trend line and then it moved. But again, you had a really nice move to the downside when it was all said and done. So again, I didn't want to get in too much detail on every one of these trades. I wanted to give one example starting from the hard right edge and show kind of what I'm looking at, how I would be taking profits if I were doing the stock. I'm going to go through a specific example today, and I really want to put it all together. For the last month or so, I've been providing videos showing how I use the moving average environment in two different time frames to really find critical setup points, entry points which provide low risk and improve your timing. What I'm going to do today is I'm going to add in MACD and I'm going to add in ADX and show you how I use those indicators together to really identify the best stocks to trade. And also, and this can be applied to the market, as I've said in prior videos, even if you're looking to do it on in a 401k with ETFs, these methods work across all different time frames. If you want to do it on an intraday basis, it will work from that standpoint as well. But I want to focus in on something. It's going to be some monthly, weekly, daily combination, some different things taking place. But I think if you can get better at understanding how to use ADX and MACD along with these moving averages, your win rate's going to go way up, and you're going to start finding the stocks that really have the ability to make bigger gains and faster gains. So please hit that subscribe button if you want to hear more videos like this. This is the type of content I provide on Tuesdays and Fridays. All right, let's go into the videos here. Let's look at the charts. So I'm going to use Anglo Gold AU as my example today. And I'm using TC2000 again. There's a link below. If you have an interest in this software, there's a $25 discount if you go through the link that I have underneath. It provides, over the next few months, I'm going to be showing you a lot of different things, abilities this specific software has. And it's very unique in the way that it allows you to do screening. It's so simple and so fast.
I find it to be very, very helpful for me. So I use it every day. So let's go through and look at this stock. So on the left side, I've got a monthly of the AU, and on the right, I've got a weekly chart. The 18 and 40 is overlaid on the price chart, and then underneath, I've got the standard MACD 12.26.9, and I use 13.8 for ADX below. The blue line is the actual smoothing ADX in both time frames, and green is the plus DI, and red is the minus DI. So just a quick review, when it comes to ADX, green shows the strength of the buyers. The red shows where the minus DI shows the strength of the sellers. And the blue line is essentially an average of the difference between these two lines. So it is a powerful indicator because it's showing you three different things at once. It's showing you how strong the buyers are. It's showing you how strong the sellers are. And then the blue line is sort of giving you an indication of how strong the trend is. And it doesn't matter which direction the trend is. It could be in either direction, positive or negative. That blue line will go up if it's a strong trend. So let's go through. I'm going to show you a specific example, something that has really been highlighted. I mean, gold actually has been sort of an unsung hero when you look at what it has done. Not a lot of people talking about it, but a lot of the gold stocks have really kicked in and started to make nice moves. And we've made some pretty good money in these stocks. So I thought I'd just bring up, I thought it was a good example. So if we start with the monthly, if you notice what took place, the 18 MA on the monthly chart crossed above the 40 MA on the monthly. And that happened during, or actually the pullback took place during the bear market. So really what you did was, when the crossover took place and then you had the bear market, it caused this to come in the zone and then come out of the zone on a monthly chart. And if you notice what we see on the MACD, so in my book, I talk about a pinch play, and essentially that's what took place on this pullback on the monthly, where the MACD line came down and pinched down towards its signal line without breaking it. And then if you go and you look at the MACD during this period, the ADX during this period, you had a really strong DI, green DI, showing the strength of the buyers was very strong. And then during the pullback, yeah, it came down under 25. But if you notice what took place, because there was still pretty good separation between the green and the red lines, the plus DI and the minus DI, ADX stayed well above 25, which is the horizontal line I've got drawn here. So when I get a pullback in a market that's showing the right type of moving average environment, and ADX stays above 25 throughout the whole pullback, all the way back into, when you get in between the zone between the 18 and the 40, and ADX is still holding above 25, that's a very, very bullish sign. It's showing you a sign of strength. Now, the same thing can be true when you're going to the downside. If the 18 is below the 40, and they're both declining, and you get a rally up into the zone and ADX stays above 25, that's also a very bearish sign. So this is sort of the starting point, is what we want on the higher time frame. If we go to the weekly chart here, notice that one of the patterns that I talk about in my book is a zero line reversal. And that's exactly what ended up taking place on a MACD basis. So this came down, started to turn right as the signal line was reaching the zero line, the MACD started to turn back above. And we can see that the trigger took place as price came back above the 40. Now, if you notice, the 18 was below the 40 and price closed below both lines. So this is the same moving average setup that I've described the last couple of weeks. So I like using the combination of different things. All this is in my book. All these patterns are in my book, but I wanted to make sure I made a pretty good point of this. Now, let's take one more look at the ADX. So if we go and see what took place on an ADX basis on the lower time frame or the weekly, you had pretty strong ADX because it was well above 25 during these rallies to the upside. You had a strong move here and then a strong move here, and you can see the blue line got up to 45, 50 on both of those peaks. And then during the correction, and even through this very, very difficult period here for this stock where it broke both moving averages and sold off to the downside, notice how weak the ADX was
during this period. So let me just make sure you can see this. So as the stock was selling off through this period, ADX couldn't even get back above 25. So what that tells me is that, yeah, there was a harsh sell-off taking place, but when you compare the strength of the sellers, the red DI couldn't even get above 25. So if I had a red DI making a big move up to 35 or 40, I would really shy away from this as a potential as it crossed back above the 40 here, because it would tell me that the sellers are a little too strong in the near term and they've sort of taken over. And normally it takes more time to get a reversal back to the upside. But in this case, if red DI cannot even get it back above 25, now all of a sudden I'm thinking any type of strength back to the upside, and I can take my price, my moving average signal and get long. And so that's kind of how this worked out on a monthly and then a weekly. Now, I'm going to switch this chart to a daily because I want to show you why this works in different time frames. So we've already shown how this took place here on the monthly and the weekly. Notice what took place after, though. You had a really strong move on the weekly, and then you pulled back. Now, in this case, you didn't make it all the way back to the moving averages, and I'm totally okay with that, especially when, if you look at what took place on the price action, you had a really strong move and then you pulled back to price support. So don't get too hung up on forcing a stock to come back and touch the 18 or come into the 18, between the 18 and the 40. You have to take it in the context of what's going on with the price action. And because the move was so strong, you have to accept the fact that sometimes you're not going to get a move all the way back to those MAs. So I would view this as a very strong move to the upside and then a nice pullback. And if you notice, again, let's take a look at what was taking place on a ADX basis and a MACD basis. First of all, the MACD. So we got the pullback after the strong move to the upside. Notice what took place here. We talked about the pinch play on the monthly. If I go back and tell you, so this is the pinch play on the monthly, right, on the pullback. Now, let's look at what happened on the weekly. We got the same pinch play take place coming in here into support, and we got this little pinch where MACD came down close to its signal line. And so that's sort of your highlight on the higher time frame and say, okay, I really ought to start taking a look at this on the daily chart. But let's take one more look at the ADX. So I'm going to expand this out a little bit. And if you notice, when this was pulling back, so we had a strong move to the upside and then we pulled back. But if you notice what ADX was doing, it crossed above the 25. 25 is a very key line. If you're crossing above the 25 level, it's telling you they have the ability to trend in that time frame. And you're starting to kind of grow in the strength of the trend. And then when we got the pullback on the weekly and it came down to support, notice how the ADX line did not turn down. It either stabilizes here or it keeps rising. And when that takes place, it starts to highlight for me, okay, this is a stock I want to look at on this pullback. So if we look at what's taken place, the MACD is giving you a bullish pinch play, and the ADX has got a rising environment showing you there's pretty good strength. Even through the pullback, it's telling you that this is a pretty strong bullish trend. So let's go take a look at the daily now. And then again, you'd want to go back and look at the prior videos I've talked about with the easy moving average setup. It's been out there for probably 2-3 weeks, something like that. And on the higher time frame, I say I want a rising 18 and a rising 40, where the 18 is above the 40. On the lower time frame, I want the 18 below the 40, and I want price below both. And then I'm going to take a cross when this price crosses back above here on a closing basis. That's your buy signal. And so that would be right around $26. And then you're going to put a stop in underneath this low here. So if I'm buying this stock at 26, I've got to stop in around 23.5. And then I'm going to play my targets going up to the upside. So let's take a look at the daily and say, okay, I know the moving average environment is what I want, but look at what the MACD is doing here. So we had the 18 cross down below the 40, and then look at the MACD doing a perfect zero line reversal, not even crossing down below. It just hovered right at the zero line. And then the trigger is confirmed with the crossover of the moving average, and MACD starts to cross over its signal line. And again, through the pullback, notice how light the ADX was. In other words, the MACD could not get, even through the decline. Yeah, DI crossed up a little bit above 25, but look at how low the ADX was during this pullback. So this is a great example, and you want to go back. If you read my book and then you understand, look at some of these videos, you want to go back through and look for examples of this and see if you can see it on 2 consecutive time frames like this. Sometimes it takes place in 3 time frames, and I'll be giving you examples of that as we go forward. But if you can do this in 2 time frames, where the higher time frame is telling you the strength of the trend and giving you a pullback, and showing you the pullback is not very strong, meaning you don't have a lot of strength in the sellers during the pullback phase, and MACD is confirming that. And then you go down to the lower time frame and realize I've got this the moving average set up, but can I get confirmation on both a MACD and an ADX basis? And when you have all that, if everything comes together that way, your odds of success are going to go way, way up. Because just realize something. If you play the game where you say, if I get 1-to-1, in other words, if I bought this at 26 and I stop it out at 23.5, I'm risking $2.50 there. So if I get a move of $2.50 in my favor, I know for the way I trade that is a win. It might not be a big win, but it's definitely going to be a W for me. And I'm going to take a partial profit, probably like a quarter of a piece off, and I'm going to go to a break even, and I'm going to see if I can turn this into a big winner. But just getting that stock to that first target is going to put you in the win column. And I'm telling you guys, you start to trade this way, and your win rate starts to go up, and you start to use MACD and ADX to help your timing and in your stock selection. You'd be very surprised how well you can do. I think you'll do a lot better if you stay on these time frames, monthly, weekly, daily, but you can still do the same thing on the smaller time frames. You just have to accept the fact that it's going to have a smaller win rate.